Hello everyone, good morning. My name is CA Rahul Gupta. So I have cleared my chartered accountancy exam in May 2022 exams. So I started my CA journey in December 2017, wherein first I appeared for the CPT exam, which I cleared in the month of January 2018. Then I appeared for CA Inter exams in the November 2018, which I cleared. Thereafter, I started with my articleship. So I have completed my articleship from Khimji Kuvarji and Company LLP. So the firm is known for the statutory audit and it ranks 13th in the Mumbai. So mostly it performs the audit activities along with the Big Four wherever there are the joint auditors. So this firm is mainly known for the statutory audit. So I was working with Khimji Kuvarji and Company since March 2019 till March 2022. So this 3 year journey have been specifically into the statutory audit department as well as the tax audit, which we used to handle along with the statutory audit. So for whichever clients we used to perform the statutory audit, for same clients we used to also perform the tax audit. So that was mainly into the statutory audit department. I have completed my graduations from KG Somaiya College of Arts and Commerce. So that was a plain, which we can call it as a Bachelor of Commerce. That was just a simple graduation field that I have chosen. Thereafter, when I cleared my CA examinations in July 2022, so the result for May 2022 came in July 2022. So thereafter, post my qualification, I joined the HDB Financial Services. In HDB Financial Services, I have been assigned with the responsibility to manage the financial reporting activities for investments and borrowings. Also, I was a manager leading the team, wherein the team was responsible to perform the activities such as reviewing the daily cash flow, what was the planned cash flow, what is the actual cash flow, inflow or outflow was there for the day, then planning what all payments are to be made in respect of the borrowings made or in respect of the interest on the borrowings. As a part of month-end activities, we also used to perform the computation of the interest, getting a confirmation from the respective banks or the lenders to understand what is the amount due as per their calculation, what is the amount due as per our calculation because of the fluctuating interest rate. So all this was a part of one of the activity that I used to perform when I was there in the HDB Financial Services, managing the investments and borrowings and the financial reporting of the investments and borrowings. I was also a part of the team which was dealing with the RBI reporting part for liquidity coverage ratio and also the ALCO reporting, the asset liability management committee is there. So we used to prepare a ALCO reporting for their review and further action purpose. This is which they used to take a decision with respect to what all investments are to be made in the future, where do we they need to make the investment for making investment or for the purpose of loans and advances that they are going to grant to their customers. So from where they are going to source the funds in. So all those were part of the role that I was performing when I was there in the HDB Financial Services. So I have served HDB Financial Services for the period of 7 months. Thereafter, I have joined the Ernst and Young LLP India. So in 26th of April 2023, I joined the ENY. So in ENY, I have been joined into the Technology Risk Assurance Department, where I am performing the audit of the controls, or simply in simple language, we can say that what I am doing is simply an internal control, but it is specifically or more inclined towards the part of IT. So wherever the controls are automated through a particular tools or application. So we are reviewing those tools and application, how the automation have been done, what all control risk are there identified by the client and what all controls are being placed by the client. So basis the risk identification of the risk, what all controls are there. So we were reviewing those things. So it is basically called as a SOC audit, Service Organization Control Audit, SOC 1 audit, we call it a SOC 1 review also we can say. So since last 2 years, 9 months approximately, I have been working with ENY in the field of technology assurance, where I am doing the SOC 1 assignment. So there are few additional fields as well, which gets covered as a part of this role. So where we do specifically test the IT related application controls, and the IT general controls, but I'm specifically doing the SOC 1 reporting activity. So that was all regarding my background when I qualified my CA, what all work experiences that I have, all those things. So today we are going to start with the discussion for the financial management subject, wherein we are going to discuss about, or we are going to learn about the investment decision as a part of my capital budgeting. Okay, so it is the module number 7 is there. So not the model. So in this chapter, we are going to learn about how do we make the investment decision, where to make the investment, and how do we evaluate which investment is better for us, or which investment will help us to maximize the profitability or maximize the wealth of the shareholders. Okay, so I will be taking you through the institutes module. So we will be referring to the institutes module to solve the sums and to read through what all things are there, the theory portion, and even the illustrations or examples that are mentioned in the institute module. Okay, I have few summary notes or kind of just a rough working with me, so that I will be presenting while we are going to discuss about those things. Okay, so let us start with the discussion about the capital budgeting part. Now, what do you mean by capital budgeting? So, as the term itself says that it is dealing with the capital or the long-term investment plans of the company. So, it is more relevant when a particular company want to expand their business, expand the products that they are going to sell into the market, or if they are going to acquire any other entity, whether it is a vertical, horizontal, vertical expansion in a supply chain, or maybe a horizontal expansion in a supply chain. Okay, so when a company wants to expand its business, so then they are going to make a large amount of investment. They are going to buy a machinery, plants, and equipment. Then they are going to install it. That is going to incur for those all this purpose. They are going to incur a large amount of money. And once the plant or machineries are purchased, they are installed in the plants or the factories. So as we understand that these are the large equipment. So suppose if we just take an example that a particular company wants to expand its manufacturing unit. So currently they are manufacturing 1000 units of a particular product. Now they want to expand their manufacturing capacity, and they want to expand it to the extent that they can produce at least 2500 quantities for a particular product in a particular year or a financial year. Okay, so currently the capacity of the entity is 1000 units per financial year. Now they want to expand it to 2500 units per financial year. Now, when they are going to expand, they are going to buy the additional plants and equipment and install it. For that, they are going to incur a large amount of expense. But what if they are not able to sell those 2500 units in the market? What if the demand for the products that they are selling that is limited to the extent of 1200 or 1300, or let's say 1500 units only? So in this case, even though they have expanded the capacity, so initially it was 1000 products per financial year, now they have expanded it, but the demand for the product in the market is limited up to 1500 quantities only. So every year they are going to manufacture 2500 quantities of the product. So this is going to lead to a overproduction, correct, which they are going to have a stock in the warehouse. Again, for warehousing the things, they are going to incur a warehousing cost. Then they have expanded the capacity by 1500 quantities. Currently, it was 1018 units. Then they have expanded it to 2500 units. Correct. So they have expanded it, but so the differential quantity is 1500. Though the demand for the product in the market was just 500, but they have expanded it to 1500. Now, the reason for expanded was that they have assumed that, or they have analyzed as per their research that they have performed, that demand for the product will go further or increase further in the market. So that was their assumption, or that was their research activities which they have performed. But when they expanded the capacity, then they identified that they are not able to sell more than 500 additional quantities. Then it is going to lead to a higher cost for them. Correct? They are going to incur a fixed cost for the maintenance of the machinery that they have installed. Correct? So once they have installed, then reversal of decision, that is going to be difficult task for them, because they have incurred a large amount of money. They have bought the money from somewhere else, from the investors or from the lenders, or from the banks or somewhere. Correct? For that, they have to make a fixed payment of interest on the loans that the bank has provided, or they have to make the fixed payment of dividend to the preference shareholders or the equity shareholder who have invested in the company. Correct. So whenever we are going to make such decision with respect to the expansion or the acquisition of a entity, or expansion of the business unit, or a launch of a new product, let's say, so we need to be careful about our decision. We need to analyze, we need to perform the research regarding what is the capacity or what is the demand for the product in the market by acquisition of a particular company or by launching a new product, how it is going to benefit a company. Are we able to generate a positive cash inflows for us, basis which we will be able to maximize the wealth of the shareholders, the equity shareholder who have invested, who have trusted the company. So they need to be careful about whenever they are going to launch a new product, whenever they are going to acquire any business or expand the current business activities that they are going to perform. So, as a part of capital budgeting, there are three decision making activities that we perform. So, first is we need to make a decision regarding the financing decision part, where we will discuss about how are we going to raise the funds, whether we need to raise it through the equity shareholder or through the preference shareholder to whom we are going to pay the fixed amount of dividend, or through the issue of loan or debentures, to whom again we are going to make a fixed amount of interest payment, or we are going to make a borrowings from the bank. What is the extent to which the bank can say, lend the money to us? What is the extent or capacity of the company that they can issue the debentures, and then it can get subscribed by the investors in the market? That is again depending upon the goodwill of the company, how the company operates, how the profitability or the size of the company is there. So all these factors are going to affect the financing decision. So whenever we are going to discuss about the financing decision part, so we will discuss about the sources of the funds, from where are we going to get the money. So while making the financial decision, we need to also ensure that the leverage ratio is correctly maintained. So by the term leverage ratio, I mean the debt to equity ratio. So the standard debt to equity ratio, as we are aware, that it is 2 is to 1. So for 1 rupees invested by the investors in the company, they can raise. So this is just a standard ratio, that the debt can go up to the 2 rupees. So that is just a standard ratio, not necessarily that you should have the ratio of 2 is to 1, but higher debt ratio indicates that the company is more risky, or company has bought more funds from the outsider. Suppose if we say that the debt ratio is 5 is to 1, it means that for every 1 rupees invested by the equity shareholder, they have bought 5 rupees from the outside investors, maybe from the preference shareholders, or maybe from the debenture holders, or maybe from the banks they would have borrowed. So all these things are discussed in financing decision part. So the sources of funds are there in the financing decision part. Then we are going to learn about the application of the fund, which we better call it as an investment decision. So we have bought the money as per our plan. Now we need to decide, where do we need to invest the money, where can we invest the money, and we can get the maximum profitability out of the money invested by the us. Suppose if we say that we have a three options available with us for the purpose of investment, but we have the limited sources of funds available with us. So because of that, as per our plan, we won't be able to invest in all the three plans. So in those cases, we will have to invest in either of the two plans. Correct? So we need to take decision regarding out of those three plans, which two plans shall we select so that the wealth of the investors, all the shareholders are maximized, so that the company's profitability can be increased. So like that, we are going to discuss all the investment decision part in this chapter. So which is our currently area of focus. And the third part as a capital budgeting is taking a decision regarding whether we need to um, pay the dividend to the investors or the shareholders of the company. So again, just to summarize the thing regarding the dividend decision making. So if the company is able to retain the dividend with themselves and get more profit generated out of the retained dividend, then it is suggested that company should retain and should not distribute the dividend to the shareholder. They can further invest the money that is as a part of profit they have earned, and then they can help them to maximize the wealth of the shareholder. However, so again, it again depend upon what is the expectation of the shareholder. Suppose if we say that the shareholder expects that whatever is the profit of the company, whatever is the amount available for distribution to the shareholder, out of those money available, if the shareholder expects that the company should give them the return of at least 10%. Okay, so now in this case, the company needs to take a decision whether they are able to generate more than 10% returns for the shareholder, or it is less than 10% for the shareholder. So if the company performs the analysis and concludes that they are able to generate a 12% return or a 15% return for the money that is retained and not distributed as a dividend, so in this case, company shall retain the money. Company shall reinvest the money that is available for the distribution to the shareholder. However, if the as per analysis of the company, if they conclude that they are not able to generate more than 10% or even 10%, they are able to generate only 7 or 8% of the return. So in this case, the company shall distribute the dividends to its shareholders, so that shareholders can invest as per their will somewhere else and get the return of the 10%. So ultimately, the whichever decision we are going to take, whether it is an investment decision or a dividend decision, we need to ensure, or we need to just take care of the things that the wealth of the shareholders are maximized. Okay, so that was just a summary of capital budgeting. In the capital budgeting, we discussed about the financing decision, then we discussed about the investment decision, and then the third thing we discuss about is the dividend decision. Now we are going to focus specifically on the investment decision part. So I will just present my screen. So we will just go through what all things are mentioned in the module for the theoretical part of the investment decision. Then we'll go ahead and discuss specifically one of the like when we are going to discuss, we will discuss the theory part as well as we will solve few examples. So just to get the more clarity about the thing. So okay, so this is chapter number 7 from the financial in management module, which is dealing with the investment decision. If you see the header. So let us start with the discussion. So the purpose of capital budgeting, as I explained, so whatever investment that we are going to make, that is a substantial investment that is going to be for a long-term period, and there is a irreversibility when we are going to invest any money out of that, right? Because once the money is invested, that they're taking the decision back or terminating any projects, that is going to be highly costly for the entity. So they won't be able to take the decision back once they have invested, or they have installed the plants and equipment, or they have acquired the business, as the case may be. Correct. So all those things we have already discussed regarding the substantial investment that will be made. This is for a long-term period. Then the decisions are irreversible. We won't be able to reverse the decision, and the complex decision-making part. So when the research activity that we are going to perform, or the decision that we are going to take, that is going to be based upon the research that we are going to perform, and that is going to be a time-consuming task. Okay, now we have the capital budgeting process here. So first we need to make a plan. So first we need to identify the potential investment opportunities that is available with us. So if you see here, the first planning part is planning. In planning, we have this identification of potential investment opportunities. So as we discussed, the example that we took is, suppose we have a three investment opportunities available with us, but due to the limitation of the funds, we are having the capacity to invest only in the two of the projects. So we need to then go ahead and identify which project will help us to maximize the profitability for the entity, or which product or which expansion business opportunity will help us to maximize the wealth for the shareholder. So first we are going to make a plan. We are going to identify what all business opportunities are there. Then we are going to determine the or evaluate the project, like which project will help us to generate how much return, like what will be the cash inflow out of the different projects that we are going to have. And then we are going to select the projects. Among the projects, we are going to select the project which is going to maximize the wealth of the shareholders. So thereafter, once the selection activity is done, then we are going to implement the project. Like we will buy the plant and machineries, we will install and then start with the production. And then at the end, once the financial year is completed, we will monitor the progress of the projects. So whenever we have invested in a particular project, as per our analysis, as per our research or assumption, we have estimated that we will be able to sell more than 1000 quantities. So in the sample that we took, the initial capacity of the plant was to produce 1000 products. Then we expanded the capacity of the plant to produce the 2500 products. Correct. Now the expansion capacity is 1500. Now initially when we expanded, then as per our research performed by the people within our organization, it was estimated that we will be able to sell the additional 1500 units. But as I mentioned that after the end of the year, then when we perform the actual versus planned product sale for the year, then we noted that we are able to make the sale of only 500 additional quantities instead of 1500. So 1000 for the additional 1000 quantities that is left with us. For that, we will have to make a like we will have to store the product in the warehouse. For that, again, we are going to incur few cost. Correct. So all these things need to be taken care of whenever we are going to make any decision. So just to conclude this capital budgeting process, so first we are going to make a plan. We are going to identify the investment opportunities. Then we are going to evaluate which investment opportunity is able to generate the highest profitability for us and able to maximize the wealth of the shareholders. Once those things are completed, then we will select the project, we will implement the project, and then at the end of the year, we will analyze, we will again monitor the project whether the project is able to generate the return as per our expectations. Okay, so all these things we have discussed. So the expansion or the diversification, this part is just the theory part. So we'll just move ahead with the further the methodologies to estimate or to make the decision. So how do we evaluate whether which project to select? So there are few traditional methodologies which we also call it as a non-discounting methodologies. Then we have the discounting methodologies, so which we will be covering further. So let me just come to that page once. Capital budgeting techniques. So here we have this traditional or non-discounting techniques, and then time adjusted or a discounted cash flow techniques. So as a part of traditional or non-discounting techniques, we have payback period and accounting rate of return. And as a part of discounted cash flow techniques, we have a net present value, then the profitability index, then the internal rate of return, discounted payback period, and modified internal rate of return. So from the exam point of view or from the this syllabus which is there with us for the inter CA currently, the time adjusted or discounted cash flows are more relevant or more important for us. But just to get the understanding of this, we need to also discuss regarding the traditional or non-discounting part first. So we will quickly discuss about the payback period and the accounting rate of return. Then we will go ahead with net present value, profitability index, and the other parts, which will get covered as a part of discounted cash flows. So as the name itself suggests, the payback period. Payback period means what? So when we have taken the decision that we will have, so out of the options or out of the opportunities that is available with us, basis the limitation of the fund, we are going to invest in a particular project. Suppose if let's say that we had the three projects in our of three projects or three opportunities available with us, with the limitation of the funds that we will be able to invest in either of one of the projects with a fund capacity of 10 lakh rupees suppose. So we have our investment amount available with us, that is 10 lakh rupees. Now we are going to estimate year on year how much return we will be able to generate by investing this 10 lakh rupees. So suppose if we have invested 10 lakh rupees, the first year we are able to generate 3 lakh rupees. In the second year, we are able to generate 4 lakh rupees. Then in the third year, we are able to generate 5 lakh rupees, assuming that the life of project is 3 years or the life of machinery in which we have invested is 3 years. So 3 lakh rupees for the first year, 4 lakh rupees for the second year, and 5 lakh rupees for the third year. So 5 plus 4 plus 3, it comes to 12. Okay. So by investing 10 lakh rupees today, we are able to generate 12 lakh rupees over the period of 3 years. Now, by the term payback period or in this first technique, we are going to analyze within how many years we are able to recover the amount invested by us. So let me just come to this rough sheet. So year 1, 2, 3 is there. So year 0, that is the time today, or here we have the cash flows. So here we have invested 10 lakh rupees. So it will be in the minus negative. Then in the first year, we have 3 lakh, 4 lakh rupees and 5 lakh rupees. Okay. So this is the cash outflow for us. And these all things are cash inflow for us. So total cash inflow and the total cash outflow. So this comes to 12. Now we need to analyze within how many years we are able to generate or we are able to recover the cash invested in the initial year. So we need to analyze, we need to evaluate within how many years we are able to regenerate or get back whatever amount we have invested. That is 10 lakh rupees. So in the first year, we have generated a cash flow of 3 lakh rupees. In the second year, we have generated a cash inflow of 4 lakh rupees. So this comes to 7 lakh rupees. Now for the additional 3 lakh rupees, how much time it will take? So in the third year, we have generated 5 lakh rupees, correct? But we wanted only 3 lakh rupees to be recovered so that our initial cash outflow is covered. So we are going to do or perform the interpolation. So in a 1 year, so this is for the third year. So we are going to perform the interpolation activity through which we will be able to see how much return or how much time it will take for us to generate 3 lakh rupees. So in a 1 year, we have generated 5 lakh rupees of cash flow. So this is rupees in lakhs. This is also in lakhs. So for generating the additional 3 lakh rupees, how much time it will take? So if we cross multiply the things, it will be equal to 1 into 3 into bracket, and this will be divided by 5, which comes to 0.6. So it is going to take 0.6 years for us to generate the additional 3 lakh rupees. So within first 2 years, we have generated the return of 7 lakh rupees, and for additional 3 lakh rupees, we are going to time that is required is 0.6 years. So the time that is taken to generate the overall return or overall cash outflow, or to get back the initial cash outflow of 10 lakh rupees, is 2 years plus 0.6 years. That is 2.6 years. So this is 2.6 years are required in order to generate the initial cash outflow of 10 lakh rupees. So this is all that is discussed in the payback period. So in payback period, simply we are just analyzing how much time it will get to generate for us to recover the initial cash outflow. So let me just charging is low. Let me just plug in the charger. Okay, so let us continue with the discussion. So we have discussed the simple method of payback period. So let me just come to the example that we have in here. So I have noted down the examples for uniform cash flow, then for non-uniform cash flow. So the example that we discussed was for the non-uniform cash flow. So example 4. So in module, if we have this example 4 on a page number 7.19. Now in this example, we have the total cash inflow on year, like after the reduction of all the expenses and the taxes, we have the cash inflow is 20 lakh rupees. So this was the initial cash outflow. So 20 lakh rupees, we want to recover it over the period or over the life of the project. So how much time it will take us to recover the 20 lakh rupees? Now, in this case, in the question, it is mentioned that each year the cash flow will remain same or the constant. So year on year, for each year, we are going to generate the cash flow of 4 lakh rupees. So we will simply divide the 20 lakh rupees with 4 lakh. So the amount, the answer came it as a 5 years. So we are able to generate or get back whatever amount we had invested initially within the period of 5 years. So this was in case of a uniform cash flow. But when it is uneven cash flow, then we need to perform the activity the way I have solved in this rough example. So in the first year, it was 3 lakh, 4 lakh, then 5 lakh. Then we have just performed the interpolation activity just to get as at a derived result. Okay, so let us just move ahead and we can just go ahead and discuss about the average rate of return or the accounting rate of return. Okay. Now, accounting rate of return or the average rate of return is simply calculating what is the net income generated by you on a overall investment made by for in a particular project. Suppose if we take an example 7, so Times Limited is going to invest in a project a sum of 3 lakh rupees having a lifespan of 3 years. So 3 lakh rupees is the initial cash outflow. Life of the project is 3 years. And at the end of 3 years, they will be able to get like the salvage value of the machinery is after end of 3 years, they will be able to generate 90,000 rupees. And thereafter, the profit before depreciation for each year is 1,50,000. So for the 3 years, profit is going to remain constant 1,50,000 for each and every year. So in the table, if you see year 1 to 3 is given, then the profit before depreciation is mentioned as 1,50,000. Okay, then profit after tax and value of investment in the beginning and end of the each year shall be as follows. So this is again given in the question itself. So first of all, we need to calculate what will be the amount of depreciation. Because when we are going to consider or when we are going to calculate this average annual net income. So this net income is after the consideration of depreciation amount. So we have a sum of 3 lakh rupees invested and the salvage value is 90,000. So the computation will be like 3 lakh minus 90,000. It will be 2 lakh 2 lakh 10,000. Now this 2 lakh 10,000 we need to depreciate it over the period of 3 years. So year on year depreciation will be 70,000. So this is mentioned in the question as well. If you see, depreciation amount is 70,000 for each and every year. And after depreciation, we have a constant profit of 80,000 per year. And this is the computation of value of assets after each of every year. So the initial cash outflow was 3 lakh rupees. Now at the beginning of the year, value of assets was 3 lakh rupees. Then we have reduced the depreciation out of that asset. So 3 lakh minus 70,000, it will give you 2 lakh 30,000. Then for the second year, opening balance is 2 lakh 30,000. If we reduce further 70,000 of the depreciation, we will arrive at 1 lakh 60,000. And likewise, we will arrive at the value of depreciation or value or salvage value of the machinery or the closing value of the machinery at the end of third year as a 90,000. Now, there are three methods by which we can calculate the average rate of return or accounting rate of return. First is when we are calculating it on an annual basis. So simply we are going to consider each and every year's profit after depreciation, and we are going to divide it with the initial investment or the investment at the beginning of the year for each year. So that was the purpose of calculating the amount at the beginning and the amount at the end. So in the first year we have generated a profit of 80,000, and this 80,000 was generated on an investment of 3 lakh rupees. So if you see in the computation for year one, average rate of return is calculated as 80,000 divided by 3 lakh rupees. So the answer came as 26.67. Now in the second year, again the profit remains the same. The profit is 80,000 after depreciation. But in the second year, we have reduced the value of depreciation from the initial value of assets. So at the beginning of the first year, the value of assets was 3 lakh. Then we have reduced the depreciation of 70,000. So at the beginning of second year, the value of assets was 2 lakh 30,000 only. So in the second year, for the second year, the returns of 80,000 that we have generated, that is on an investment of 2 lakh 30,000 rupees. So that is how the average return ratio is calculated for second year. 80,000 divided by 2 lakh 30,000, which came as a 34.78%. And in the similar way, for the third year, beginning value is 1 lakh 60,000, beginning value of assets. So we are going to divide 80,000 with 1 lakh 60,000. So we get a result of 50%. So average rate of return for 3 years will be dividing all these three in the annual returns by 3. 3 years return we have summed up here, and then we have divided it by 3. So we arrived at the average annual rate of return as 37.15%. So this was when we have considered each and every year's cash invested amount for into the asset for the purpose of calculation of average rate of return. Now, if we consider investment in the beginning itself for the purpose of computing average annual profit. So for each year, we have the return of 80,000, 80,000, 80,000. So even if we try to get us average of this, so for this average, we need to sum up 80,000 plus 80,000 plus 80,000 divided by 3. This will come to 80,000 itself, since the profit for each year is same. In case if the profit would have been different, like for the first year, suppose if it is 80,000, for the second year it is 90,000, for the third year it is 1 lakh. So we would have done 80,000 plus 90,000 plus 1 lakh divided by 3 to arrive at the average profit for 3 years. And then we would have divided it by initial investment of 3 lakh rupees. So as per the version 2 or the second methodology of calculating average rate of return, in this case, we have the average profit for the 3 years divided by the investment in the beginning of the year. So this will give us the result of 26.67%. And the third methodology is there, where we are going to consider average investment basis. Now, in this case, we have a formula to calculate the average investment. Now, as we are aware, so generally we calculate the average investment as the investment at the beginning of the year plus the investment at the end of the year divided by 2. That is the basic formula. But in this case, the institute has provided the formula for calculation of average investment. So we need to consider the value of assets after reducing their salvage value, one half of that. So initial value of assets was 3 lakh rupees, salvage value was 90,000. So one half of 2 lakh 10,000 we need to consider. Then we need to add the salvage value in that. So again, this is dealing with the same activity which we discussed, like summing up the initial investment, like the investment at the beginning of the year and the investment at the end of the year, then dividing it by 2. But in this case, they have simply reduced the salvage value and then they have taken the average, like by dividing it by 2. So 3 lakh minus 90,000, 2 lakh 10,000, one half of 2 lakh 10,000 plus 90,000. So we arrived at the average investment amount of 1 lakh 95,000. So again, we already have the average annual profit available with us that we computed in a second methodology as 80,000. So 80,000 divided by this average investment amount of 1 lakh 95,000. So we the result came it as a 41%. Okay, so this all was the traditional method or a non-discounting method of computation of the returns that we are going to generate out of a project or computation of a payback period. So the time that we are going to take in order to get back whatever we have invested in initially or at the beginning of the year. But the main criticism of following this method is that we haven't considered the time value of money. So when we computed the payback period, we have taken the raw figure of 3 lakh, 4 lakh, and 5 lakh. Here in this case, we didn't computate the time value of money. So what do you think? So the value of 100 rupees today and value of 100 rupees after 3 years, will it going to remain same? Suppose if we enter into a contract, or if I told you that I will give you 100 rupees either today or 120 rupees after 3 years, suppose. So what will you prefer? Will you prefer to get 100 rupees today or will you prefer to get it after the end of 3 years? So that is again depending upon what is your expectation about generating a return. Suppose if you say that if you give me 100 rupees today, I will be able to invest this 100 rupees for the period of 3 years. And at the end of 3 years, I will be able to generate a return up to rupees 130. So in this case, you will say that I want 100 rupees today itself instead of getting 120 rupees at the end of 3 years, because you are capable of generating the return more than what I will give you after the 3 years. Correct. Now taking another example for a easy understanding of the time value of money. Suppose if we take an example of vada pav. So 10 years before it was sold for a rupees 10. Now it is sold for a rupees 20 or maybe say a 25. Now again, the quantity or the size of vada pav remains the same. Still, the price of vada pav has increased. So that is what is the time value of money. So the value of 1 lakh rupees today is not going to be same 1 lakh after even after 3 years. It is going to reduce. So this reducing factor or reduction factor or the time value of money while computation of this payback period or average rate of return is not considered in the traditional method. So that is why we are going to discuss now about the discounted cash flow method, where we are going to consider the time value of money, and by considering the time value of money, we are going to evaluate how to select the projects. Okay, so the first techniques that is under the discounted cash flow methodology is the net present value technique, or NPV technique we call it as. So in this net present value technique, what we are going to do is, suppose in the same example that we took, the example one. So in the first year, the cash outflow was minus 10, like the cash outflow was 10 lakh rupees. And then over the period of 3 years, we are able to generate the return of 3 lakh, 4 lakh, and 5 lakh rupees. This is the raw figure, or this is, we can say, without discounted, non-discounted amount. Now, this cash inflows at the end of each year, at the end of 1 year, 2 year, and 3 year, we are going to discount it with the relevant discounting factor. Now, what is going to be a relevant discounting factor? So, as we discussed initially at the beginning of this discussion of chapter itself, that first decision that we need to make is regarding financing or the sources of fund from where we are going to get the money for the purpose of making investment. Correct. So when we are going to raise the money from the banks or by issue of debentures or from the equity shareholders or from a preference shareholder. So for a preference shareholder, we are going to make a fixed payment of division, fixed percentage of division, dividend payment. Then for the purpose for to the debenture shareholders as well, we are going to make a fixed percentage payment on the amount invested by them. For banks also, we are going to make a fixed amount of payment as per the rate of interest that is agreed with the bank. So these three sources of funds are where we are going to make a fixed payment. Then comes the equity shareholders. Equity shareholders ko generally we don't make any payment as such. So like there is no mandate as such to pay any rate of dividend or any amount out of the profitability to the equity shareholder. But when the person has in any person or equity shareholder has invested in a company or any entity or any project, so they have expectation that the entity will be able to generate me a return or get me a return of at least suppose let's say 10%. So that is the expectation of the equity shareholder having regards to the market factors. So what is the rate prevailing in the market? According to that, what is the risk taken by the company? Considering the rates in the market and the risk taken by the company, equity shareholders set their expectation. Okay, so the rate of return again we are going to consider for the equity shareholders as well, even though we are not going to make a fixed payment, but we need to, whenever we have raised the money and we are investing ultimately somewhere, that the ultimate purpose is to generate a profit and to maximize the wealth of the shareholder. So to in order to maximize the wealth of the shareholder, we need to give them what is their expectations. Correct. So the expectation of the equity shareholder are also going to get considered. So whatever we are going to make payment to the preference shareholder, debenture holders, or the banks, along with that, the expectation or expected rate of return of the shareholder. These four factors will combine and we will derive the cost of capital. So these all things are discussed in the financing decision chapter. So where we have learned about the cost of capital, we have learned about how to compute the expected rate of return for the equity shareholders. So we will utilize the knowledge that we have earned in the financing decision chapter, and basis that we will calculate the cost of capital for the purpose of discounting the cash flows that is going to be generated in the future. Okay, so suppose the 3 lakh, 4 lakh, and 5 lakh rupees is generated, that is a net cash inflow for each and every year. Okay, now each and every year we have generated the positive cash flow. Okay, but we need to evaluate whether we are able to recover the initial outflow for the project or not. Correct. So let me just delete this. So here we have the discounting factor. So this is the cash flows in lakhs. Then we have a discounting factor. Okay, for discounting factor, I have this sheet now. So suppose if we say that the cost of capital, so cost of capital is nothing but what is the minimum rate of return the entity should be generating on the amount invested by them so that they are able to make payment to the preference shareholders, to the debenture shareholders, or to the bank and fulfill expectation of the equity shareholders. So that is what my cost of capital is there. So whenever I am going to invest in any projects, I need to evaluate, I need to ensure that I am able to generate a minimum rate of return or minimum cost of capital so that at least I can pay off whatever is the amount payable to the respective shareholders and to the banks. Otherwise, if there is a negative cash flow, ultimately we will be in a loss. We won't be able to make the payment and the project will not be viable for us to be continued. Okay. So for that purpose, we are going to consider the cost of capital in order to evaluate whether we are able to generate the required rate of return or the minimum required rate of return so as to continue a particular investment opportunity or a particular business. So if after this, after considering the cost of capital and after discounting the future cash inflows, we are able to generate a positive net present value, a positive net value, then only we should go ahead and continue with the projects. If we are generating the negative value, then we should not be continuing with the project. Now, how do we calculate the discounting factor? Okay. Or how do we calculate for the purpose of discounting the cash flows in the future? So suppose let's take an example that cost of capital, or which we also call it as a KO. So cost of capital, let's say it is a 10%. Okay. Now, in order to discount any amount, we need to divide it with the cost of capital. So how do we divide it? So here we have the discounting factor calculation. So for purpose of calculation of this discounting factor, we are going to perform this activity in a calculator. So it will be 1 divided by 1 plus KO. KO is nothing but my cost of capital. So it will be 1 divided by KO, that is 10%. For to so 10%, we can also write it as a 0.1. Correct? So this will be 1 plus 0.1 raised to the number of years. So we are going to calculate it for the first year, it will be 1. For second year, it will be 2. Similarly, for third year, it will be 3. For fourth year, it will be 4. And for the fifth year, it will be 5. So here, if you see, so if we do this 1 divided by 1 plus 1 raised to 1, this will be for the first year. So the same activity we have done. So 1 divided by 1 plus 1, 1.1, sorry. 1 plus 0.1, that is 1.1 raised to 1. For the second year, it will be 1 divided by 1.1 raised to 2. So here we have given to the power 2. 1 divided by 1.1 to the power 2. Similarly, for third year, it is 1 divided by 1.1 to the power 3. And for the fourth year, and similarly for the fifth year. So these are the discounting factors for each and every year. So this discounting factor we are going to consider for the purpose of calculating the present value of net future cash inflows or outflows. So I have just copied the discounting factor that was calculated here for the purpose of calculating the net present value. Okay, so this we have done. So now we are going to calculate the present value. So in this case, for the year 0, it will be 0 only, or it will be 1, we can say. For year 0, the discounting factor will be 1. So if we multiply this by this, so we need to multiply the cash inflows and outflows with the discounting factor. So we'll arrive at the present value. So these 3 lakh, 4 lakh rupees and 5 lakh rupees we are going to generate at the end of each year, like year 1, year 2 and year 3. But when we want to understand and we want to calculate the value of this 12 lakh rupees as on today, as on the day 1, when we are going to do the investment. So for that, we are going to discount it with this amount. So we have got this amount, which is reflecting the amount that is as on today. Okay, so if we compare the present value here, so present value, so let me just sum up the present value of all the cash inflows. So these are the cash inflow for over the period of 3 years. So the present value of total cash inflows over the period of 3 years is 9.79 rupees. That is the life of project. However, our initial cash outflow was 10 lakh rupees. So in this case, if we see cash inflow minus the cash outflow, cash inflow minus the cash outflow. So we have arrived at the negative amount of 0.21 in lakhs. So that is 21,000 is the negative amount. So in this case, we are not able to generate the minimum required rate of return. So that is why the amount is negative. So the minimum required rate of return for the shareholders was 10%. However, we were not able to generate that. That is why the net present value for this project is negative. So if the net present value is negative, or we can say if it is net present value is less than zero, in that case, we shall be rejecting the project. In case the present value is positive. So suppose if we say the discounting factor that we took as an example was at the rate of 10%, correct? So let us just make it 9% suppose. Let me just copy down everything. Okay, suppose if we consider the discounting factor to be a 9%. Now we will copy the discounting factor of 9%. It is again calculated in the same way. It will be 1 divided by 1 plus 9%, that is 0.09. So it will be 1 divided by 1.09 raised to 1. So here if we have written 1.09, so 1 divided by 1.09 raised to 1. 1 divided by 1.09 raised to 2. Similarly, 1 divided by 1.09 raised to 3. So these are the discounting factor at the rate of 9% for the 3 years. So I will just paste the discounting factors here. So we need to paste maybe only up to 4 or 5 numbers only. No need to copy whatever is there in the calculation or in the calculator. So just consider it up to 4 digits. Okay, so doing that, we will again do the same activity. We will multiply the cash inflows or cash outflows with the discounting factor. So here we have the cash inflows and the cash outflows. So let me just change the figures so that we are able to get a positive NPV. Suppose for the third year, we were able to generate a return of 6 lakh rupees. Okay, instead of 5 lakh rupees. Now in this case, let me just make it 6 here as well. Okay. Okay. So now in the, if you see now when we have the discounting rate of 9% and we have calculate the net present value. So this 10.75 is the net present value here. In the same way here this, sorry, this minus 0.21 is the net present value. In the same way, where we will calculate the net present value, which is cash inflow minus the cash outflows. So here we have a positive net present value of 0.75 lakhs, that is 75,000. So in this case, we can conclude and we can say that the project is able to generate a desired rate of return or more than that. So in this case, we have taken a discounting factor at 9%. So 9% is the minimum required rate of return, which any project which we are going to invest, that it should be generating. So if we are able to generate more than 9% return, then we can say that project is viable and we can go ahead with that. If we are generating less than 9%, then we can say that project is not feasible for us, not viable for us, and then we should reject that investment opportunity or or project. So how do we compare the percentage, or how do we calculate it? So for that we have this net present value technique. So we are going to discount all the future cash inflows with the minimum required rate of return, that is a discounting factor, to arrive at the present value. So this is the present value of cash inflow. So over the period of 3 years, non-discounted cash flow is 13 lakh rupees and discounted cash flow amount is 10.75 lakh rupees. So this 10.75 reflects that as on today, the value of all the cash inflows over the period of 3 years is 10.75, and the cash outflow for today is 10 lakh rupees. So cash inflow minus the cash outflow, we get a positive figure of 75,000. So here we can say that we are able to generate more than what is desired by the shareholders and more than what is expected by the shareholder. That is why the net present value is positive. So if the net present value is positive, then we should accept the project. If the net present value is negative, then we should reject the project. Now, what if the net present value is zero? In that case, we need to decide whether the project we are or the product that we are going to invest or make, is that project necessary, or is that product necessary for selling or increasing the sale of some another product that is complementary to what we are going to sell. So if it is a complementary product, even if the NPV is zero, then we should accept it. Right, but then again, it depends upon the nature of business, what product we are going to sell, what projects we are going to invest, or which company we are going to acquire. So that is something a practical decision. But for from the theoretical point of view, if it is a zero, we may accept or we may reject the project. But when it is negative, then definitely we should reject the project. When it is positive, then definitely we should be accepting the project. So suppose let us just quickly go through the examples in the module. So I have listed down the examples here. So we are going to solve illustration number 4 in page number 7.30 for net present value and the illustration number 13. So let us just solve illustration number 4 first, then we'll come to illustration number 13. Okay, so here we have the illustration number 4. So in this case, if we read through the question, ABC Limited is a small company that is currently analyzing the capital expenditure proposal for the purchase of equipment. Now, let me just come to this line. Capital budget is limited to 5 lakh rupees. So this is the maximum amount that a company can invest in. Now, the company has a four option or a four investment opportunity available with them. Project A, B, C, D. And initial investment that is required in each of the project is mentioned. For the project A, it is 2 lakh rupees. For a project B, it is 1,90,000 rupees. For a project C, it is 2,50,000 rupees. And then for a project D, it is 2,10,000 rupees. And likewise, the cash flow for each and every year is there for the period of next 5 years. Now, the cost of capital for ABC Limited is 12%. So it means that whichever project the ABC Limited might invest in, they need to ensure that they are able to generate a minimum return of 12%. So in this case, the discounting factor for us will be 12%. So whatever are the future cash inflows, we are going to discount it at a rate of 12% to arrive at the present value of future cash inflows. And then we are going to compare it with the initial investment or an initial cash outflow. So if initial cash, the present value of all the cash inflow over the period of project or over the life of the project is greater than the initial cash outflow or the present value of all the cash outflow, then we can say that the project is feasible for us and then we can go ahead with the project. But here we also have a limitation of 5 lakh rupees. So maybe possible that in all the four cases, we are able to get a positive NPV, but we have the amount available is 5 lakh rupees only. We won't be able to invest in all the projects. So in order to invest in all the projects, we will require this much amount. 2,10,000 plus 1,90,000, we can say it is 4 lakh rupees. 4 lakh plus 2 lakh, 6 lakh rupees plus 2,50,000, that comes to 8,50,000 rupees. So for investing in all the projects, we will require a minimum investment amount of 8,50,000 rupees. However, we have an amount available with us, which is limited to 5 lakh rupees. So in case, even if all the projects has a positive NPV, even though we might reject few projects because of the limitation of the amount available with us. Okay, so let us just see first of all whether we have the any projects let us just see if any of the projects has a positive NPV or not. And if they have the positive NPV, then we need to take further discussion regarding which project to invest and on the priority of the projects. Okay. So as I mentioned, we are going to use the discounting factor of 12%. So let us just evaluate it for each and every project. So period 0, 1, 2, 3, 4, 5. Then we have the present value factor for the 12%. Now let me just come to this sheet. So here if you see, we have in the way we have computed it for 10% and 9%. In the same way, we have computed it for 12%. So for 12%, it will be 1 divided by 1.012 raised to the number of years. So here if you see 1.1 divided by 1 plus 0.12. So here we have 1 divided by 1.12 for the first year. For the second year, we have 1 divided by 1.12 to the power 2. So this is for the second year. This is for the third year in the same way. Then similarly for the fourth year and fifth year. Okay, so these are the discounting factor. If you see, these will exactly match with whatever is mentioned here. So I have considered 5 digits here for computation of discounting factor. In the module, it is given 3 digits. So if I reduce the number of digits, it will exactly match. So for the first year, it is 0.893. In the same way, here it is 0.893. For the second year, 797, it is there. Then for the third year, it is 0.712, 0.712 for the third year. For the fourth year, 0.636, 0.636, and then fifth year, 0.567. So this is exactly magic. So discounting factor that is given in the module is correct. That we can conclude here. So we are going to use this discounting factor and then we are going to compute the net present value. Okay. So for the first year or for the period 0 horizon today, the present value factor will remain 1. So for each and every year, or for each and every project, we have considered what is the initial investment amount, and then whatever was the project cash inflows over the period. So for the first year, suppose in case of this, it is 50,000. So we are going to multiply it with this. So let me just present you here. So at least for one of the sample project we can check. Then for other projects, you guys can continue with the computation. So for the project A, it is 50,000 for each year. This is constant. So let me just write 50,000 for each year. So we are going to multiply the future cash inflows with the discounting factor. So for comparison purpose, I will just make it again a 3 digits. So here if you see, this is the future cash flows. This is the present value of cash flows. I hope this is clear to you guys. Okay, so this is future cash flow. This is the present value of cash flow. So if we want to match it with the module, so this is 44,643, 44,650. This is because of the rounding of differences. So if I just make it directly 0.893, so this will exactly match. So because I have all the decimals in the computation, that is why it is coming as a the figure is little bit different. Otherwise, if we match it on overall basis, there will be a little bit of difference. So in the same way, we have computed it for the second year, third year, fourth year, and the fifth year. So if we sum up this, so this comes to 1,80,239. So this is the present value of cash flow, a total of present value of cash inflow over the period of time of the project. However, in case of this project A, we had the initial cash outflow of 2 lakh rupees. So if we are going to compare it with present value of cash outflow, so this is 2 lakh. So in this case, the net present value is negative 19,000. Here we have 750. Here we have 761. So the difference of 11 is there. That is because of again the rounding off. Okay, so that difference is fine. So okay. Okay. Now in this case, we have a negative cash outflow on the NPV is negative, the net present value. So in this case, you can say simply to reject the project because the NPV is negative. Now, in the same way, we are going to make a computation for project B, project C, and project D. So if you see in the same way, they have made the calculations here. And if we compare the NPV of each and every project. So for project A, it was negative. For project D as well, it was negative. So project A and project D simply gets rejected because of the negative cash inflows or the negative net present values. Okay. Now we are going to compare project B and project C. Now in case of project B, we have a positive net present value of 25,635. In the project C, in the similar way, we have a net present value of 27,050, and the total amount that is required to be invested in the project B and project C is 2,50,000 plus 1,90,000. So if we make the sum of these equal, it will be 2,50,000 plus 1,90,000. This is 4,40,000. Correct? So 4,40,000, we have amount available with us for investment 5 lakh rupees. So this is well within the limit. So we have excess amount available with us 0.6. So this is well within limit. So we can invest in both the project B as well as project C, because the amount that is required to be invested in project B and C is within the limit available with us. And also both the projects have a positive net present value. So we should be accepting both the projects and investing in those. Okay, but what if I say that we have an amount available for investment is 3 lakh rupees only? Suppose we have amount available is 3 lakh rupees. So in that case, we will be able to invest either in project B or in a project C. So because of the limitation of the amount available, we had to choose either of the project. Then on what basis will you select which projects to invest in? Both the projects has a positive NPV. However, the initial cash outflow for both the projects are different. Correct. So in this case, we have another methodology or another technique which we call it as a profitability analysis. So let me just come to that. The profitability analysis or a profitability index, where we conduct a comparison of sum of discounted cash inflow divided by the total discounted cash outflow. So simply in this case, we are going to compare the total of cash inflow with the total of cash outflow in order to arrive at which project is viable. So let me just quickly explain it to you. So let me just come to the illustration number 13. So here we have everything. That was on a page number 7.53. Okay. 7.45, 51, 52, and 53. Okay. Okay. Now, in this case, I will just quickly summarize the question instead of reading the question in detail and solving. I will just help you to understand how do we select the project and how do we rank the projects. So in this case, if you see, this is the initial investment amount for each and every project. So this is 50, 40, 25, 30, 35 in thousands, and then NPV, net present value, at the rate of 15%. So this is the net present value. In all the cases, we had the NPV positive. So all the projects was viable and we can go ahead and invest in all the projects. However, we have a limitation with respect to the amount available for investment. So the capital available for investment is only rupees 1,20,000. So we won't be able to invest in all the projects. Correct. So we need to rank the projects on the basis of their NPV. So whichever project has the highest NPV, that will be ranked at first, then the second, third, fourth, and fifth. So likewise, if you see, out of all the NPVs of the respective projects, highest is 19.3. So this is being ranked as 1. The second ranking is to the 18.7. This is the second highest. Then third highest is Third highest is 15.4, then fourth highest is 11.2, and at the end we have this 10.1. So here the rank is given to be incorrectly done. So you guys can just make the note of things in your module if you have it handy with you. So first ranking will be to 19.3, second will be to 18.7, third will be to 15.4, and the fourth will be to 18.7. If we are going to compare it on an overall basis. Okay. Now, if we see, we have the additional column of NPV per rupees one invested. So for each and every rupees invested, so this is again a comparison of the total cash outflows with the total cash inflows. The simply we are going to compare it for each and every rupee invested by us. What is the net present value that we are able to generate? Okay, so if we match it on an overall basis, this is going to give us a different ranking for project A and project C. But if we compare it on a NPV basis or a profitability index basis. So in this case, so for suppose for a project A, for a rupees 50,000 invested, we are able to generate a net present value of 15.4. Correct. So how much are we able to generate for each rupees invested in the project A? So that comes as 0.31. So this is simply computation of. So we are able to generate 15.4 rupees, correct, on an investment of 50. So this is 0.31 per rupees invested by us. So if we compare it on a NPV per rupees invested basis, so this will come as a 0.55 is the highest. That is the first ranking. Then the second ranking goes to the project B. Then the third ranking goes to the project C. Then the fourth ranking goes to the project D. And then the fifth ranking goes to project A. Sorry guys, initially I just thought that the ranking is based on overall basis. So that is why I just mentioned that we are going to check it on overall basis. But the ranking should be on a NPV per rupees invested basis that we discussed in the profitability index or profitability analysis, right? So where we were comparing what is the net present value or generated for each and every rupee invested, or what is the total cash inflow for total cash outflow. So that is what is getting discussed in the profitability index. So if you want the profitability index part to be ignored, so we haven't discussed it in that detail, so that you can ignore. So for the purpose of easy comparison and for the purpose of because in each and every project we have invested the different amount. So the rough figures or the raw figures directly we cannot compare. So that is why we need to first compute the NPV for each rupee invested by us, and basis that we are going to go ahead and give the ranking to each and every projects, and basis that ranking we are going to evaluate which project to invest in. Now we had the total amount available with us for investment, that is rupees 1,20,000 rupees. Now if we invest in a project E, so we will be able to generate NPV of 19.3 plus total investment. What will be, so let us just first compute what will be the total investment amount if we invest in the top three rankings of the projects. For the project E, we are going to invest 35. Then the second ranking is to project B 40. So 35 plus 40, it comes to 75. And then to the project C, it is 25. So this is for the third rank project. So we are going to invest 1 lakh rupees in project E, then project B, and then project C. So this will help us to generate a total NPV of 48.1 thousand rupees. Okay. We won't be able to invest in a project D because this require a minimum amount of investment amount of 30,000, and we have a buffer of 20,000 rupees only. In the same way, A requires an investment of 50,000. We won't be able to go ahead with that because of buffer of only 20,000 available. So either we can invest in the project E, B, and C, where we will invest total of 1 lakh rupees, which will help us to generate a return of 48.1. Now we still have the buffer of 20,000 available with us. So what if I say instead of investing in project C 25 rupees, 25,000 rupees, what if we invest in project D 30,000 rupees? So if we invest in project D instead of C, so it will come total as 35,000 plus project B 40,000, which comes to 75,000 plus 30,000 of project D, which sums up to 1 lakh and 5,000 rupees. And if we sum up the NPV of project E, project B, and project D, so this will give us a total NPV of 49.2. So if you see here in this case, since we had the buffer available with us, so we had an option to choose either of the project C or project D along with project E and B. So if we choose the project C along with E and B, we will be able to invest 1 lakh rupees, and on that we will be able to generate 48.1 thousand rupees, like the 48,000 rupees. However, instead of C, if we invest in project D, we will be able to invest total amount of 1 lakh 5,000, and we will be able to generate a higher NPV, and in order to maximize the wealth of the shareholder, that is 49.2 thousand. So given the choice, we should be investing in the project E plus B and D so that the wealth of the shareholders are maximized. I hope you guys have understood till now whatever I have explained. Thank you so much for joining the session. Have a good day. Bye bye.